Okay, so today we're going to take a deep dive into this triple whammy of economic news, right? You sent me this video from way on YouTube, and it's like bam, 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 three things happening all at once. Inflation's hotter than we thought. Global trade's going kind of haywire with all these tariffs, and then oh yeah, there's this huge short-selling attack on this AI advertising company. Kind of crazy, right?
Yeah, it's wild, isn't it? I mean, it seems like all these things are separate, but they're actually all kind of connected. Inflation, trade wars, tech stocks getting hammered. They're all pieces of the same puzzle, this big global economic puzzle.
Exactly, and that's what we're going to try to unpack today. So first up, got to talk about the U.S. inflation numbers. Specifically, the PCE, the Personal Consumption Expenditures Index. The markets definitely reacted not in a good way. NASDAQ down, S&P 500 down, Dow down. Some sectors got hit particularly hard, like communications, consumer discretionary, tech, financials, materials, all down.
Yeah, pretty much across the board, except oddly enough, utilities went up.
Right. Utilities, the one bright spot.
Hmm.
Makes you wonder, maybe folks are getting a little spooked and moving towards safer investments. But yeah, the PCE numbers themselves, well, the headline number wasn't too bad. It matched expectations. But when you dig a little deeper,
Yeah, the core PQE. That's the one that really spooked the markets, right?
yeah, the core PCE, which strips out food and energy prices, jumped by 0.4% in February. Biggest jump in over a year, and, well, it was higher than analysts predicted. Plus, the year-over-year figure hit 2.8%, also above expectations.
It is a bit of a red flag, isn't it? The core PCE is usually seen as a more reliable indicator of underlying inflationary pressures because it takes out those volatile food and energy prices. And to see it not only beat the forecast but also jump that much in a single month, well, it suggests that this inflation thing might be stickier than we thought.
Right, like it's not going away anytime soon.
Mm.
And as the video pointed out, it's not just one thing. Both goods and services contributed to this rise in core PCE.
Exactly. On the good side, inflation was up 0.2%, not as much as the previous month. But still, after that period last year where goods inflation was practically flat, even dipped into negative territory for a bit, well, this increase could signal that we're heading back into a period of rising prices for goods. And the 3-month average, if you annualize it, is now sitting at 3.2%.
Okay, so goods are a concern, but services. Services seem to be the real sticky wicket here, right?
Yeah, services are definitely the bigger worry right now. That 0.4% increase in services inflation is pretty concerning, especially when you look at the 3-month average, which, if you annualize it, comes out to a whopping 4.4%. That's way above the Fed's target of 2%. And what's even more worrisome is the jump in supercore inflation.
Supercore, what's that? Like inflation with a cape.
Haha, not quite. Super core inflation focuses on the prices of core services, but it takes out housing, which is closely tied to wages.
Mhm.
Think of it as the price of, your everyday services, like getting a haircut, going out to eat, transportation, that sort of thing. And this super core inflation, well, it saw a pretty big jump too, 0.37%. This all suggests that there are these underlying price pressures in the economy that go beyond just the potential impact of tariffs or, temporary supply chain issues.
So basically, this inflation data is throwing a wrench into the whole inflation is cooling down narrative. And the source even mentions this disconnect between what the market is expecting, like 3 interest rate cuts this year, and what some Fed officials are saying. Some are even suggesting that, well, maybe we won't see those rate cuts, or maybe rates will have to stay higher for longer because of this pesky inflation.
Yeah, that's a big question mark right now. What happens if the Fed feels like they have to keep interest rates higher for longer just to get inflation under control? That could definitely have a ripple effect on the economy, right? It could slow down growth, make borrowing more expensive. The markets seem to be in this weird limbo where they're hoping for rate cuts, but the economic data is saying, hold on a sec, not so fast.
Right, it's like a tug of war. And then there's this other interesting tidbit from the PCE report about how people are earning and spending. Personal income jumped by 0.8%, which is the biggest increase we've seen since January of last year. But here's the thing. Inflation-adjusted spending only inched up by 0.1%. That's a huge difference.
Yeah, that gap is pretty telling, isn't it? It could be a sign that people are starting to get a little more cautious with their money. Maybe they're feeling the pinch from inflation. Maybe they're worried about higher interest rates. Maybe it's just the general uncertainty in the air. Whatever the reason, if people are spending less, well, that can have a knock-on effect on the whole economy.
Yeah, if everyone starts tightening their belts, businesses feel it, growth slows down. And this whole idea of consumers getting more cautious is reflected in the University of Michigan Consumer Sentiment Index for March. The source highlights this widespread pessimism, and not just from one group, but across the board, Republicans included, about their own finances, the economy in general, and, of course, inflation. What really jumped out at me was that two-thirds of consumers expect unemployment to rise. That's the highest level since 2009.
Yeah, that's a big deal. Consumer sentiment is a powerful force in the economy. When people feel good about the future, they spend more, businesses invest, and the economy grows. But when they're pessimistic, well, it can really put a damper on things.
Right, it's like a self-fulfilling prophecy. But then there's this other piece of data that seems to contradict everything we've been talking about. Longer-term Treasury yields actually went down.
Hmm.
The source suggests that this could mean that the market is more worried about a potential slowdown in the economy than about inflation spiraling out of control.
Yeah, it's kind of counterintuitive, right? But it speaks to how complex the markets are. A drop in longer-term treasury yields can sometimes indicate that investors are bracing for slower growth down the line. It's like a flight to safety, where investors flock to less risky assets, like government bonds, when they're feeling uneasy about the economic outlook. So yeah, the immediate inflation picture is pretty scary, but the bond market might be telling a different story, one where the economy cools off and eventually brings inflation down with it.
Okay, so it's not all doom and gloom. All right, let's shift gears now and talk about tariffs and what's happening in the wild world of global trade. This is like a never-ending saga, right? Always something new popping up. Our source points out that the deadline for those reciprocal tariffs between the U.S. and the EU is coming up fast, April 2nd. And it
Yeah.
sounds like the EU is, well, they're not exactly thrilled about it.
Yeah, it seems like they've gone from trying to prevent these tariffs to just trying to minimize the damage. Reports are suggesting that U.S. officials have told the EU point blank that these tariffs on cars and other goods are a done deal. And the EU's response is interesting. They're basically putting together a list of things they might be willing to offer to sweeten the deal, kind of soften the blow.
Yeah, like lowering some of their own tariffs, maybe easing up on some regulations, potentially increasing investment from U.S. companies. But it's not just about those direct tariffs, is it? There's also this whole issue of non-tariff barriers, the things the U.S. has been complaining about for ages, like VAT, digital taxes, those food safety standards they have over there.
Exactly, and those are much harder to negotiate. These non-tariff barriers aren't your typical import taxes. They're more about the rules and regulations that a country or region has in place. The U.S. argues that some of these rules are specifically designed to make it harder for American companies to compete. The EU, on the other hand, insists that these rules apply to everyone equally, regardless of where they're from. And it's this fundamental disagreement that makes these trade negotiations so tricky. Plus, the EU is trying to emphasize the fact that the US actually has a pretty big advantage when it comes to services like e-commerce, social media, all those big tech companies. They're trying to use that as leverage, to counter the US focus on the trade deficit in physical goods.
Sounds like the EU's trying to come to the table with some bargaining chips of their own. They're even considering increasing imports of U.S. liquefied natural gas, maybe buying more defense equipment from the U.S. That's a big deal. But even if they reach some kind of agreement, I get the feeling things won't just go back to normal.
Right. The whole global trade landscape has shifted. These tensions aren't going away anytime soon. And it's not just talk. The EU is already moving forward with its own countermeasures against those U.S. tariffs on steel and aluminum, the ones that were put in place a while back. They're targeting a whole bunch of American products, including whiskey, motorcycles, some agricultural stuff. And they're even considering taking it further, maybe imposing quotas, excluding U.S. companies from government contracts, and even messing with intellectual property rights. They're not playing around.
Oh, it's getting serious. Trade war, part 2. But hey, at least there might be some good news on the horizon with Canada.
Yeah, that announcement from Donald Trump on social media about his phone call with the Canadian Prime Minister, it sounded surprisingly positive. He called it a productive conversation and said they agreed on a bunch of stuff. And they're planning to have more talks right after the upcoming Canadian election to discuss trade, politics, all sorts of things. The goal, according to Trump, is to come up with solutions that work for both countries.
That's a good sign, right? After all this talk about tariffs and trade wars, any kind of de-escalation is welcome news. But the source did point out that the markets didn't seem too excited about this U.S.-Canada news. Maybe they're just not convinced yet, or maybe everyone's still fixated on the inflation numbers.
Yeah, it's probably a combination of both. The inflation situation is pretty front and center right now, but these trade dynamics are still important to watch because they can have long-term effects on the economy.
Absolutely. Okay, last but not least, let's talk about that short-selling attack on Applovin, the AI advertising company. Their stock took a 20% nosedive after Muddy Waters Research issued this pretty scathing report. What exactly are they accusing Applovin of doing?
The main accusation is that Applovin is inflating its advertising effectiveness, especially in the e-commerce world. They rely heavily on this last-click attribution model, which basically means that if you click on an ad and then buy something, that last ad gets all the credit for the sale, even if you might have bought the thing anyway. Muddy Waters claims that Applovin is exploiting this model by targeting people who are already about to buy something and then bombarding them with ads, essentially taking credit for sales that would have happened
They're
regardless.
kind of sneaky, like those people who shove flyers in your face right as you're about to enter a store.
Haha, yeah, kind of like that. And Muddy Waters estimates that a whopping 52% of Applovin's reported e-commerce conversions might be attributed to this kind of, well, let's call it aggressive targeting, with only 25% actually coming from genuine ad influence. That's a pretty damning accusation. And then there's the whole issue of their data tracking practices.
Yeah, that's a big one these days, right? Privacy and all that.
Exactly. Muddy Waters claims that Applovin is tracking users across different platforms, even when those users try to clear their cookies, opt out of tracking, even when they're using VPNs. They say this might actually violate the terms of service of some major platforms, like Apple, Meta, Snapchat, TikTok, Reddit. And if those platforms were to ban Applovin's ad business, well, that would be a huge blow.
Yeah, no kidding. So Applovin's in hot water. But they're not just taking this lying down, right? Their CEO came out swinging, denying everything.
Right. He's pushing back hard, saying that their e-commerce advertising is legit, that it really does work. He's trying to draw a distinction between ads for products that people buy only once and ads for products that people buy repeatedly. He argues that for those one-time purchase products, they can see a clear increase in sales within 24 hours of someone seeing their ad.
So he's saying that they can prove their ads are effective in those cases. But what about the repeat purchases, the stuff people buy over and over?
Well, for those, he says they rely on third-party verification to prove the value of their ad traffic. But the core of Muddy Waters' argument isn't really about whether Applovin's ads ever lead to a sale. It's about how much they're actually driving new sales versus just taking credit for sales that were already in the pipeline.
Ah, okay, so it's more about the extent of their influence, not just whether they have any influence at all. Makes sense. And what about those data tracking allegations?
The CEO claims that their pixel tracking methods are standard practice, that everyone does it, even the big guys like Facebook and Google. He even pointed out that platforms like Shopify automatically include tracking information. And he mentioned this answer he got from Grok AI that suggests Applovin's tracking code is similar to what other companies use. But the source points out that just because other companies do it doesn't necessarily mean it's okay, especially if it's violating platform rules or user privacy.
Right, two wrongs don't make a right. And the analyst in the source seems to agree. They're pretty skeptical about Applovin's claims, and they find Muddy Waters' accusations credible. So, yeah, this whole thing is a bit of a mess, and it'll be interesting to see how it plays out.
Yeah, this short-selling attack is a big deal, not just for Applovin, but for any company that relies heavily on AI and data tracking. It raises some important questions about transparency and how we measure the effectiveness of advertising in the digital age. And ultimately, it's about trust, right? Can consumers trust these companies with their data? Can investors trust that the companies are being honest about their practices and their results?
Big questions, no easy answers.
Hmm.
So as we wrap up today's deep dive, what are the key takeaways for our listeners?
Well, first off, we saw how a hotter-than-expected inflation report can send shockwaves through the markets, making everyone nervous about rising prices and a potential economic slowdown. And the mixed signals we're getting from the Fed, with some officials hinting at rate cuts while others are pumping the brakes, it just adds to the uncertainty.
Right, it's like trying to read tea leaves.
Hmm.
And then there's the whole trade situation, which is always a roller coaster. The EU is bracing for those new tariffs, but they're also trying to find ways to mitigate the damage. Meanwhile, things might be looking up with Canada, but the markets aren't getting too excited just yet. And finally, we have Applovin, which is facing serious accusations about its advertising practices and its data tracking. It's a reminder that even the most innovative, high-flying companies aren't immune to scrutiny, especially when there are questions about how they operate and how they're using our data.
And what's really important to understand is that all these things are interconnected. Inflation influences monetary policy, which impacts economic growth. Trade policies affect inflation and business confidence. And the scrutiny we're seeing applied to companies like Applovin is a reflection of broader concerns about valuations and ethical practices in the tech world.
It's all connected, like a giant web. And by understanding these connections, you can make more informed decisions, both financially and in terms of how you interact with the digital world.
Exactly. So here's something to think about. Given all the uncertainty in the air, inflation, consumer behavior, trade wars, tech scandals, what if the biggest surprise isn't any one of these things in isolation, but rather how they all interact and create something totally unexpected? What assumptions are you making about the future based on what you see happening today? And are those assumptions maybe a little too simplistic? The world is complex, and sometimes the most unpredictable outcomes are the ones that change the game completely.
Food for thought. Thanks for joining us on the deep dive.
My pleasure.